Well, good morning. This is Michael DeVille coming to you from beautiful Phoenix, Arizona. Tatum and Heather and I are here in incredibly well appointed West USA studios. And this is another Creating Real Estate Wealth webinar. This is a really special one today because we want to start the year off with my forecast. And I'm going to tell you the forecast is very, very positive. So I'm going to tell you that right up front. Now, this is a kind of a my give back to you. You know, I've been in this for 4 decades. My life has been absolutely incredible. And I'm going to tell you over the holidays, I did some research, and I'm going to tell you that this is an astounding figure that over 100 million Americans do not have a retirement account for themselves. Now, we're going to live a lot longer than you think. So you need to start thinking of what are you going to do to provide for yourself after you retire, because you don't want to work for the rest of your life. You may want to work, but you don't want to have to work. And retiring is a financial decision, not an age decision. And of course, you have an opportunity right now to start getting your finances in order, start building a portfolio of homes for yourself. You're sitting into the accumulation phase. Things are going to get better. The best is yet to come. And all you have to do is just start, and we are here to help you in every way we possibly can. That's my mission, is to give back to you. And that's what this webinar is for, is to help you, maybe motivate you, give you some ideas, give you some thoughts. And if it helps, that is all that I ask, is that we get this going for you. Now, next week, we're going to start getting started. How do you start? How do you get your business going? How do you get your investments going? We've been talking about this for the last 4, 5, 6, 7, 8 months, giving you some thoughts. We've taken you right through my book, giving you ideas on how you can get this done for yourself. Next week, we're going to start talking about how do we get started doing business and getting our portfolios together. Now, this is West USA's Give Back to You. I'm here to help you any way I possibly can. Any suggestions, I will listen to you, because we want you to have a great, great life. So let's get on with this. Today's topic, forecast for 2021. Now, last year was a very interesting year. An awful lot of fear in that, and it turned out to be one of the best years we ever had. 2020 was just phenomenal. I think we have a continuation of 2020 coming, but wait, let me go to this next slide. We put some nice, now, I try not to give you too many slides. You know, I can't help myself sometimes. So here's the forecast. I've looked at this and received this from Goldman Sachs, courtesy of Zero Hedge, and I have to tell you, this is their forecast for 2021. Now, let's just look at this. If you look at Q1, Goldman Sachs is thinking that we are going to do 5% GDP. That is an astounding figure. When you think that Obama was a president for 8 years, he never had a quarter exceed 3%. We're talking about a quarter that's going to go to 5 in the first quarter of 2021. That's this quarter. The next 3 months are going to explode to 5%. Now, here's the even better one. Now, we can look pretty confidently out about 6 months. Now, we have a timing model. We're going to talk about the timing model. Timing model gives us a pretty good guide. But as we go through the economy and start looking at all the other things that are happening, we can really get a very good feel for the next 6 months. And this next 6 months are going to be terrific, historical, absolutely off the charts. Now, Goldman Sachs is thinking second quarter, which really starts what? January, February, March, April 1st, is going to be 8.5%. 8.5% in one quarter. Obama couldn't get 3. This is going to be 8.5. Can you imagine the business? So let me just explain why that's going to happen. We talked about that last year when we had that $6.8 trillion go into the economy. We said you're not going to see that for 12 to 18 months. Now, the stock market took off right away because it's probably the most liquid market in the world. So you start putting this liquidity into the economy, and the stock market just takes off. But we talked about the fact that it takes 12 to 18 months for Main Street. We are Main Street. We're all the people that are really working for this liquidity to start coming into the system and working its way through. And second quarter is when that's going to start. We're going to have $6.3 trillion. And what did we just get a couple weeks ago? This chart does not reflect the fact that we just got almost $1 trillion in stimulus like 7 to 10 days ago. That is not yet into the marketplace. And there is always kind of a little bit of pop. So that's going to be on top of this. So personally, I think second quarter could go to 10% second quarter. I'm going to tell you, a 10% second quarter is historical. We are going to be so busy, you're not going to be able to see your family because you're going to be doing so much business. And it's going to be very, very good. So the next 6 months, just get prepared for things getting better and better and better. Now, this is the M1 money supply. You can see, again, how we're confirming this. Now, the FRED is the Federal Reserve Electronic Data System. Doesn't get much more authoritative than that. If you look into the right corner, you can see almost a vertical line, almost $3 trillion in just money supply got put out by the Federal Reserve, and that is into the system. It's coming its way through. That means that there's plenty of funds to fund every project there is. There's just so much liquidity. All we need is that spark, and we are going to go like crazy. So the money's there. We've put all of the ingredients are there in the cake. We just have to bake it, and that baking is coming very, very soon. So the next slide, I want to talk about the fact that the U.S. dollar, we talked about how high the U.S. dollar could possibly get. Now, we talked about that last year. We said, when you go into turmoil, everyone goes to the U.S. dollar. Now, that's great for the United States because that causes deflation here and inflation across the world. And everybody goes to safe haven, which is the U.S. dollar. Now, we talked about the U.S. dollar could have peaked up around 110, 112 on the DXY. It did peak almost to 103 in March of 2020 at the very depth of the recession. And then it has started down ever since. So when I put this slide show together for you in January 4th, that day the DXY was down to 89.75 at 12, almost a 13% drop in the dollar. Now, we could go to 74, 75, 76, which would be an enormous drop. So as the U.S. dollar, we're the reserve currency of the world, the function of the U.S. dollar is to make sure that there's a supply of dollars across the globe, and the U.S. dollar, when it gets strong, is very, very difficult on the economy. As it gets weak, the world does very, very well. And you can see that as the U.S. dollar dropped, the economy started going and the whole world started doing much better. Now, one of the things that you notice is that the S&P gains over 16%. We had a 13% drop in the dollar. How much of that drop was caused by the U.S. dollar? So you need to talk to your financial advisor and see what is good and prudent for you in a stock market. In any of the investments that we talk about, you should really talk to your financial advisor. I will make myself available if you want to talk to your spouse, of course, your advisor. We're more than happy to brainstorm and see what is going to work best for you. But again, these are ideas that we're bringing to you and some thoughts, and we'd like you to take them and run and see if there isn't something that's even better. Now, let's talk about something a little closer to home. Now we're talking about the fact that the builders are going absolutely nuts. They're looking 4, 5, 6, 7, 8 months in advance. They're being concerned about cost. And this is why copper from 1 year to 1 year. So I went from December 2019 to December 20. Copper is up 25.7%, and that's including that drop in the recession. So copper prices plummeted, but even considering that, we're up 25%. Lumber, it's up almost over a double, 116% in 1 year. So if you're a builder, you got to be concerned about that. Steel up 63% in one 12-month period. 63%. And it's not just confined to basic materials. You're going to see corn is up, and I pulled this up too. Wheat is up 15.5%. And keep in mind, who is the greatest producer of wheat in the world? And that is the United States of America. And our wheat, the basic wheat, where you get your pasta and you get your bread and all the buns, wheat, flour up 15.5% at the producer level. So we've talked about this. So we're going to talk about it a little further. When these prices go up, what in the world do we make out of copper, lumber, and steel? Homes, houses. When you see the basic production, when the builders' prices start to go up, and they're concerned that 8, 9, 10 months out, the prices might even be higher, what does that tell you? Now, we've been talking about the accumulation phase, which is what we're in. That means when things are starting to move, you should be starting to add to your portfolio right now. Because looking at this, we talked about the fact that for the first time in a decade, we're seeing inflation. And you can see this. This is the statistics. You can go to Market Watch or CNBC or Bloomberg and go ahead and just plug it in and see this for yourself. This is happening in basically all the basic materials, and it's telling you that everything that's manufactured is going up in price. Now, this is an opportunity for you to get in and start adding to your portfolio and helping with your clients. Keep in mind, 100 million Americans have nothing. So here's our opportunity to help our friends and our family to get something going, because I think that inflation is coming. And when you get inflation, you need to be concerned about your purchasing power. Because if you retire at 65, your money needs to last you 20, 30, 40 years. And inflation will just decimate lots of portfolios. So on that cheery note, let's move to the next one. I'm using this industrial slide again from the Federal Reserve electronic data. Can't get any more authoritative. If you look at the shape of this chart, this is pretty much the same chart that you're going to see in all the GDPs, manufacturing, industrial commodities. They're all trending pretty doggone close to this. It's showing that we had a very, very steep decline on the recession, but it was short. We talked about that fact that it was going to be one of the shortest recessions on record. You can see it just fell, and there wasn't a slope. It just like collapsed, and then it starts to recover. Now, recovering is not recovered. So you can see that we've recovered in the last 10, 11 months. We've recovered probably 60%, 65%, and there's still trouble in the economy. But a lot of the economy is doing very, very well. If you're in construction, you can really go anywhere you want and get a construction job. Business is just booming for construction, manufacturing, industrials, Department of Defense, IT, government workers. If you were a federal worker, you didn't miss a paycheck. So lots of sections of the economy are doing really, really great. Just think what's going to happen when we get the service industry coming back. Just think when we can go to ball games and venues, and you can go to a wedding, and you can go to the theater and the movies, and you can go listen to rock and roll. You can go to the theater, you can listen to opera, you can get to all these things. When we open up the entire economy, what is going to happen with all this pent-up demand? Well, I think we're going to explode. So I think that business is going to be very, very good. Now look, here's the Case-Shiller Index. Now you know I use a timing model. You're going to see that if you go back and do my videos, you're going to see that in March of 2018 is when I predicted that we would have a correction in the ongoing bull market. That happened. We talked about the fact that that would last until the fourth quarter of 2019. That happened. Now I thought we might get a double correction. So if you look on that little dip, we got another correction. I don't know that that is a total correction. I would be surprised that it was, but we'll know in a couple of months. If we don't get another correction, then that was it. And I think we're going to go from there. And we're going to talk about another one. But you can see how well housing is doing. Housing is often counter-cyclical to the stock market as well. Let me go to the next slide. This is the Federal Reserve. Now, interest rates are absolutely rock bottom. 2%, 3%. You know, I've been in this 4 decades. 2%, 3% for a 30-year fixed rate mortgage is like a gift. If you need to get financing, if you need to refinance anything, if you're going to have some cash outlays coming up and want to borrow some money, I don't think you can get a better time than right now. Now, that doesn't say it can't fluctuate a little bit in and out and go up and down a quarter point, half a point, but it is trending higher. And if you look at this chart, you can see that the Federal Reserve has stepped in a very, very, very big way and has been buying mortgage-backed securities, that's MBS. And they're keeping the long-term interest rates down in the basement. Now, I think they're going to continue doing this. But if you have any need, why would you wait? You know, we're at such a good rate, I would say this is time for you to start thinking. Do not take an adjustable rate mortgage. You want to take a fixed rate mortgage, 30-year fixed rate. Nothing with adjustable, because I think rates are going to trend higher. So that's okay. We were in the big bubble in 05 when we had a 54% increase in our housing in 1 year, and rates were at 6 or 7%. You could not stop people from buying. If you think the business is going to be better, you're more than happy. If you think you're going to make 10%, you're more than happy to borrow at 5 or 6 or 7. If you think you're going to make 20%, you'll borrow at 10 or 12. So as long as the economy is doing well, people will pay more for their mortgages. However, I'm going to tell you right now, you have a great opportunity. So don't let it get by. Now, here again, I just picked this chart up, courtesy of Zero Hedge. I love that site. Again, showing Phoenix the #1 market in the United States. This is going to continue. Phoenix, the #1 market in the United States. Now you can go ahead and say, well, per capita. You can say on sheer numbers, but Phoenix is the #1. Maricopa County is the best place for you to be investing your money. Texas, Florida, Arizona. That's where you want to put your money. We're right here in Maricopa County. You can't get any better than where we are now. There's no excuses. No excuses. So let's go to the next chart. Again, Federal Reserve electronic data. This is only from October to October because November, December are not in. Nationally, real estate went up 7.9% nationally. I think it went up for 2020. We're going to get this. We'll get March 1st. We'll have the total year. But I think nationally, you can see the spike. You can see how we start elevating that. And once you put November, December, because we really had the best December I've ever seen. This was just a phenomenal December. I think we're going to see that nationally we had probably 8 or 8.5% increase for 1 year. You know, when I first started, if we got a 3% or a 4%, we were really happy. We're double that today. Double that. Now, let's look what's going on. So what does this tell us? Well, the trends are continuing. All those 4 trends we talked about last January, February, the trends we've got going here in the country. You know, one of the big trends we've been talking about is the fact that the baby boomers are retiring. Man, the moment you come home and say, I'm retiring, the allergy kicks in. You cannot stand cold weather, and they all move south. That's Florida, Texas, and Arizona. So there's one trend that is going to go for 10 or 15 or 20 years. And how many Californians do we have coming over here? 185 every single day moving to Maricopa County, just here in Maricopa County. Now, I see that continuing, the trends continuing, unless we have a Mad Max event. The trend is just going to continue. I'm looking out 6 months. I don't see anything that's going to throw this off. I would never have guessed that our economy would get shut down by the government. So that was the Mad Max events. If we don't have another one of those, I think the economy just continues. And look what happened in Phoenix. This is why we're the best one it is. Phoenix. Now, Phoenix, this is Federal Reserve electronic data. This is not Maricopa County. When we go into these data, I can't always get the very, specifics on here, but Phoenix, Arizona, and it picks up other parts of Arizona with Phoenix. 12.7% led the nation from October 2019 to October 2020. We've got statistics here that say Maricopa County for 2020 was like 16% appreciation across the board, depending on what price you were in. If you were in entry level, you did even better than that. We saw 20-25% on some of the entry-level properties. Some of these even more than that. Our average prices has gone up significantly in the last 4 or 5 months. We've really had price, and you can see the spike on this. So Phoenix, 12.7%, but probably when we get the statistics, I think Fred is going to show us that we're probably 14, 15. And that, of course, is price dependent. If you're in the entry level, which is where most of us play, that's our wheelhouse. When we're looking for rental properties, most of the time we're in that entry level or the next plateau above that. That is typically where we are at, and that did exceptionally well. So I think that's going to continue. You're in the accumulation phase. You should be looking for your clients and looking for yourself. Let's get you a cash flowing portfolio that's going to give you $10,000, $15,000 a month every month that will maintain your livelihood. They'll maintain your purchasing power really for the rest of your life. So next week, getting started. How do you do this? Well, you're welcome to call anytime. You are always welcome to call. You're always welcome to email and ask, because that's what I'm here for, and that's what we're here for, is to do the best thing we possibly can for you. So next week, we're going to start. How do you get started? We're going to have some classes coming up, how to get started. We've got investing coming up. Now, I'm going to tell you, if you have any questions or comments, you're welcome to email us at creatingwealth@westusa.com. If you want to get involved with us, creatingwealth@westusa.com. If you need help, if you have questions, you want to brainstorm, creatingwealth@westusa.com. You could know how to get me. I'm always around, so you can call me at corporate 602-942-4200. And I want to wish you the very, very best. Thank you so very much for listening to me. The best is yet to come. Bye-bye now.